And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning, welcome to the show. It is, of course, Tuesday. Now, normally today would be two dads on money, but my other dad is out sick today. These youngsters, they have no stamina. Get a little sniffle, can't come to work. I don't know what that's about. Anyway, I'm here with you, whether it's pneumonia, near death, whatever. We're here doing this show with you. That's all I'm saying. Anyway, just joking. John Penn is out today. He's a little bit under the weather. He'll be back next week. So we were going to talk a little bit about housing today. We're going to shift that to next week. I'm going to talk with you today a little about reflation. This is the new narrative that is now kind of invading Wall Street overall. This idea that we're going to have this economic reflation environment. This is going to lead to a very sharp pickup in earnings. And not just for the Mag 7, by the way, we're going to have a very sharp earnings pickup across the board. The bottom 493 stocks expect to have a very, very strong 18% increase in earnings this year. So again, this economic reflation narrative, it's the key, right? This is also something that is going to be kind of shaping the investment structure of the environment over the course of the next really few months as this narrative kind of takes hold. And there's some reasons for that. We'll kind of go through that narrative today. But that all suggests much stronger dollar, much stronger economic growth, higher prices for asset prices. Again, and the question is, can you do all that without creating inflation? So that's going to be the big question. So again, we'll get into this a little bit more this morning, but that's kind of the news. Outside of that, other news kind of hitting the markets this morning. So yesterday, we kicked off the day with the fact that the DOJ is threatening to file charges against Jerome Powell. Markets were opening kind of sharply lower yesterday morning. That lasted entirely about 17 seconds, and then the markets turned right around and rallied back up to all-time highs yesterday. So again, apparently not that big of an issue for Wall Street. You know, there's all this concern yesterday morning. It's like, oh my gosh, this doesn't, this means that there's no Fed independence, and market went, yeah, whatever. It's no big deal. Poly market right now has about a 12% chance that these charges are actually filed and even lead to an indictment by June. So nobody really thinks this is much more than just some political posturing. Markets saw right through that yesterday and rallied stocks to all-time highs. Now, importantly, there's a couple things going on today that are important. We started earnings today. JPMorgan announced earnings this morning. They missed earnings, but only because of a deal. It's a charge against an Apple deal they did previously. So they took a charge on that impacted the earnings. So they missed earnings this morning. Stock might be down a smidge this morning, but again, probably not a whole lot to that. Futures are basically about flat right now, down a little bit. S&P's trading down about 3, Dow's down about 13 points right now. So again, mostly pretty much a flat opening this morning. Not a lot of concern over this, but started the major banks today. We'll have a lot of regional banks this week, and then next week we'll start getting into the mega cap earnings. So the next 2 weeks, really in particular, next week and the week after, we're going to have a big influx of economic earnings reports. And we'll get through those by really about 2 weeks from now, and then we'll get back into corporate buybacks coming back in. We don't get NVIDIA, of course, the kind of the king of the earnings reports right now. That will come later. That's going to be late in February, I believe. So anyway, so that's kind of what's happening right now on that front. This morning also, we will get the CPI report. Now, this is going to be the first report. So this report's for December. This is the first report that we're going to get that's really kind of 2 months in a row of data because we imputed the October data. And so there's a bunch of skews to that. Now that imputation of the October data is expected to feed through, and there's going to be a bunch of adjustments to the December report that's going to cause potentially CPI to come in around 0.3 to 0.4% this morning. So they're expecting a hotter read on CPI as the catch-up of that imputed data kind of all gets factored in. So pretty much for the most part, disregard today's CPI report, it's not it's still being affected by that October government shutdown. We really won't start seeing actual data until until the month of January, which we'll get in February. That'll be really kind of the first kind of key month where we've had some more normalization in the data. So again, I wouldn't read a whole lot into whatever CPI report is out today. It's just still we're getting some of that adjustment back in, trying to normalize that data from October. So again, if you run the CPI data, there's a big gap in October. There's just no data. So you have to kind of, normalize that data and then try to figure out where you are from here. And again, a lot of guesses right now. We'll see what happens. Normally, market kind of overestimates CPI, so we could see a little bit weaker CPI this morning. We'll see what comes out. I don't think it moves the market much one way or the other. Treasuries are trading just fine. There really doesn't seem to be a lot of concern right now within the markets that the CPI data is anything more than probably just a one-time pass-through. So we'll see what happens, but again, we'll have more to talk about that on Thursday with Michael Leibowitz as well. Also, don't forget, it is now just, speaking of Michael Leibowitz on Thursday, we are just 4 days from the economic conference. So again, we have the mixer Friday night with everybody, and then on Saturday is the conference itself. So if you haven't gotten your ticket yet, we do have a few seats left. It's pretty full, but we do have a few seats left, and we can make some extra room if we need to. But if you would like to come, we'd love to have you. Again, it starts at about 7:30 in the morning. We're going to feed you breakfast. We're going to have lunch for you. It's going to be a good day, really good information-packed day. We'll be going over kind of what the markets are going to look like in 2026, what to expect, how to navigate it, bonds, commodities, gold, covering all of that in that report, along with artificial intelligence, the future of where that's expected to go, and also the future of stable coins and cryptocurrency, covering all that in that conference this coming Saturday. So if you haven't got your ticket yet, come on, we'd love to have you. It'll be a lot of fun, and we'll have plenty of time to ask questions and mix and mingle and visit. So I'd love to catch up with you as well in person. It'd be a lot of fun. So get your ticket online right now at realinvestmentadvice.com, and we'll do that. Okay, let's get into what you need to know before the bell this morning. As I noted, JPMorgan announced earnings this morning. They missed a little bit. No big deal. This stock has just been going bonkers for the last couple of years, really. This stock was about $100 a share about 2.5 years ago. It's now trading at $324 a share, so you've had about a 200% increase in the stock price. Been doing very, very well. This stock, out of all the financial stocks that are out there, JPMorgan, Goldman Sachs, and BlackRock are probably the three kind of the kings of the finance space. In particular. But again, stock's very overbought here, and it's been working off some of that overbought condition here over the last few weeks. You're starting to pull down into some support levels. And again, you're on a bit of a sell signal here, so I wouldn't be surprised to see a little bit of weakness. And by the way, this kind of just also corresponds to the market as a whole. And we'll get into that in just a second, but the market as a whole is pretty stretched. So again, a bit of a pullback to support would not be surprising. Around 314 on JPMorgan is kind of an interesting entry point if you're needing to add some financial exposure to your portfolio. JPMorgan and BlackRock in particular are probably on the front and center of what's happening in terms of the markets. Kind of where this kind of future of AI development and everything else is kind of pushing towards. They're going to be behind all that, financing a lot of it. So there's an interesting setup here that these stocks in particular could be, kind of drug along with the entire AI narrative just because of what happens kind of behind the scenes. You got to finance all these projects, and they're going to be kind of really front and center. Them, Goldman Sachs as well. Kind of all fall into that bucket. But like I said, that's, again, they announced earnings this morning. Stock might be down a little bit this morning, but again, it needed a correction anyway, so this is just kind of one of the reasons for it. Again, keep watching that. Talking about, like I said though, talk about the markets as a whole, kind of the same thing. Again, we had that little brief sell-off yesterday morning. Markets rallied back to all-time highs, and we're kind of back into that groove right now of setting all-time highs. And again, we're on a buy signal, but the market is getting a little bit overbought here, and we're getting a fairly decent deviation from its moving average. So again, a bit of volatility pickup here over the next couple of weeks, particularly once we get into February. would not be surprising. Again, next couple of weeks you have a little bit of support from earnings. And again, probably have a decent earnings beat rate. Will not be surprising because we've lowered estimates a good bit going into this kind of analysis. In fact, that's something I covered this morning in our daily market commentary on the website. So if you go to realinvestmentadvice.com and download our daily market commentary for today, we actually kind of talked about the earnings structure for Q4. I've had a fairly good discount on earnings expectations for Q4. That really provides a good kind of a benchmark for a beat rate that'll give us a 75-80% beat rate this quarter. But again, that could also lead to a bit of volatility once we get kind of past earnings, get into February. Markets are getting decently extended and overbought here. So again, just as a function of process, it's okay to remain long equities right now, and I certainly would encourage that. But don't forget to take profits to kind of just rebalance a little bit as you kind of go along in here, because again, we're going to get some volatility pickup. But again, that will be a good opportunity to put some capital to work on a pullback for the next leg of the rally. But things don't go, as we've seen numerous times, stocks don't go just straight up. You're going to get these little corrective environments that give you a better opportunity to put capital to work. So just be a little bit patient here. It'll be fine. But that's what you need to know before the bell this morning. When we come back, we'll talk about this reflation trade idea. A lot of people are expecting it, and maybe that's the problem. We'll talk about that next. Don't go away.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
What's the future of investing in 2026? Gain insights on how AI, technology, and the economy will shape your money in the year ahead at the RIA Economic Summit, January 17th at the Royal Sonesta Houston Galleria. Join Lance Roberts, Michael Leibowitz, and Thoughtful Money's Adam Taggart, plus top minds in AI, crypto, and retirement strategy for a powerful look at the markets of tomorrow. Seats are limited. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show this morning, and unfortunately, you just get me this morning again. I know you just had me all to yourself yesterday, so but like I said, John's a little bit under the weather this morning, so we'll pick back up with Two Dads on Friday next week. And so again, Two Dads on Friday next week, but we're going to do it on Tuesday, so we'll get there. Yeah, someday next week. Yeah. Anyway. So a couple things right now. There's a lot of optimism for this year. We've had 3 straight years of near 20% advances. It's been great. And what's interesting is that we've had really, really strong economic growth over the last 3 years because of all the monetary interventions that we had back in 2020 feeding through, right? So you had the checks to households, you had massive rounds of quantitative easing. You had, all kinds of other support that came into the markets. And we had a big expansion in the deficit, which has been now reversing. So as all that money's been coming out, we have started to see the growth rate of the economy slowing down. We've seen the rate of inflation slow down. We were at 9%, and now we're down to about 2.7%, 2.8%. So, we've had this reversal, and now what everybody's expecting is this idea of economic reflation. And there's an interesting caveat to this reflation narrative, which is that we're now going to have a resurgence of economic growth, but with no inflation. And the Fed will keep cutting rates. Well, there's a bit of a problem with that, and we'll get into that in a minute, but if you think about it, that doesn't quite make a lot of sense. But here, let's go through kind of where we are right now. Goldman Sachs just surveyed 400 institutions. I'm going to read this, by the way, just so I get it all correct. Goldman Sachs just surveyed more than 400 institutional investors, and the message was clear. Everything is bullish everywhere all at once. And they're right. S&P is at all-time highs. Russell 2000 is all-time highs. Small caps hitting all-time highs. Mid caps at all-time highs. Gold, the all-time highs. Doesn't really matter what you own. It's all going up. Everything's bullish everywhere all at once. And the idea behind this is, well, why is this happening? Well, growth is strong. Central banks are dovish. They're cutting rates. Equities keep winning. Rate cuts are coming, and recession fears have all but disappeared. So, in other words, it's as good as it can get. And that's kind of interesting because you've had, again, as I noted, 3 straight years of high double-digit, near 20% gains in equities. You've had a big, strong turn in optimism. So, the general consensus is now bullish. Everybody is bullish. Everybody's long equities. Doesn't matter what equities you own, they're going up. So why not be bullish, right? And again, in the retail side of the sector, we see a lot of speculative risk-taking, options trading, those type of things, because there doesn't seem to be any risk. I mean, if I buy stuff, it just goes up. Why am I worried about risk? So you've got economic confidence, policy easing, risk on positioning, asset allocations, by the way, at all-time highs, households as well as institutions. And this premise is that we are now going to have economic reflation because of basically 3 things. The One Big Beautiful Bill Act is now started, right? So they passed the One Big Beautiful Bill Act last year. It all goes into effect this year. So that's tax cuts, that's deregulation, that is, kind of an easing of conditions on banks in particular. We've recently seen the Fed, started to buy, $40 billion worth of treasuries to provide more liquidity to the system. So an increase in liquidity is bullish. But the deregulation, the tax cuts, the reforms, those are all expected to be very bullish for the economy. Get companies back out there working, investing capital into the U.S., business investment, et cetera. Then the other 2 kind of legs of the stool is that, of course, the Federal Reserve is going to be continuing to ease monetary policy, cutting rates, potentially doing more of this QE, not QE thing that they're doing, increasing their balance sheet a smidge to provide liquidity to the markets. And then, of course, on a global basis, global central banks have also been easing monetary policy, so that's out there. And then, of course, lastly, you have all this business investment coming in for AI data centers and build-outs and all these type of things. So that's all that provides economic input. So it's kind of these 3 legs of this idea of economic reflation. And as I said earlier, the idea of the economic reflation story is that you can have economic reflation without an increase in inflation. But this is where the narrative gets a little bit tricky. And again, we as narratives go, right? We got to hope for the best. It's like, oh, we can have our cake and eat it too, is kind of the idea of a lot of these narratives. And reflation is one of those. And we've had this, the reflation narrative is not new, by the way. Every time we go through an economic slowdown, then the economic reflation story picks up, and that always kind of is a fact. But if growth leads to employment, and if employment leads to higher wages, and higher wages lead to increased demand within the economy, which is how you get economic growth, right? Because we're 70% consumption. Then by default, inflation has to go up. Now, we're not talking about, now just keep your shorts on here for a second. We're not talking about spiking inflation. We're not going back to 9%. But if the economy is going to grow at 2.5% or 3% or 3.5%, inflation should track along that level. So in other words, if you're growing at 3.5% on a real basis, inflation should be running around 3.5%. Maybe a little bit, maybe a smidge more. That's not a bad thing, by the way. Because if the economy is doing well and you're making more money, that means you've got more money to spend in the economy, which means that your wages are going up. That's offsetting the pace of inflation. That all stays in there. But the hard thing to get your, kind of wrap your head around, to speak, is to say we can have economic growth and no inflation. The premise is that we can get economic growth without inflation because we can do that without increasing employment. That's kind of this idea about artificial intelligence and data centers and increases in productivity. In other words, we can increase productivity to the point where we don't have to hire more people. So we can keep inflation contained by not hiring as many people, which means that people don't have as much money to spend. But we're going to get economic growth from the business investment side of the equation rather than the consumption side of the equation. That's a little bit of a hard math trick to make. Because again, the economy is 70% consumption, only about 15% of the economy is business investment. So for business investment to do all the heavy pulling, you've got to have a very, very large increase in business investment to pull the entire GDP equation higher, because it's only 15% of the economy. But this is the thesis, right? And again, when you take a look at some of these charts, I've got a few charts to share with you this morning. This is from the survey from Goldman Sachs. Question is how much will GDP growth be in 2026 on an average annual basis? And they're expecting somewhere between 2 and 3% on average. So about 67% think about 3%. Now, we're currently growing at about 2.3%. So again, this isn't a far range, but they are expecting a move higher in economic growth this next year as we start this economic reflation story. In order for that to work, right, you've got to have a lot of other factors going in, but if all those other factors are working, then that should feed back into a positive equity backdrop, and that's what they're expecting. In 2026, what will global equity terms be in dollar terms? And the vast majority are somewhere between 10 and 20%. Basically positive equity returns. You've got a lot in the 0 to 10% range and a lot in the 10 to 20% range. So there's a very good consensus that this coming year we're going to have fairly high market returns again for a fourth year. Now, that 4 years of positive returns in a row of double digits is not entirely rare. That happens a lot throughout history, going back 125 years. You get into these very bullish trends in the market. So again, just because we've had 3 doesn't mean we can't have 4. Also, you have a lot of momentum in the markets to carry market prices higher. This is the interesting thing about all-time highs is once you have all-time highs, you get more all-time highs because of the momentum in the market. It just keeps dragging more and more people in. So again, the idea that we're going to have another positive year in the markets is not outside the realm of positive of probability. But again, it's kind of dependent on a lot of things really coalescing into a almost perfect environment. And the reason I say that is because of valuations. Here's a chart of valuations. So this is a look at valuations across different economies. So the US ex big tech, the world, Japan, the entire world, less Japan, so forth and so on. Emerging markets, United Kingdom, China. Every single area is trading currently at a very high valuation relative to its normal historical ranges. U.S. being the outlier in particular. So in order to sustain high valuations, just about everything you've got going on has to come to fruition all at once. Anything that comes along that impacts the expectation for earnings growth becomes problematic. And we talked a little bit about this yesterday, is that when you take a look at the markets and what you expect to come from the markets, all these other narratives and stuff, including the reflation narrative, throw it out the window for a moment and just focus on one thing. In order for valuations to stay where they are, forward earnings expectations have to remain elevated, because you have to justify paying 22 times earnings. I'm paying 22 times earnings today, and this is how this works. Yes, I'm willing to pay 22 times earnings today to own equities, because if earnings grow at the rate that they're expected to grow, I won't, that valuation of 22 times earnings will be okay, because the earnings will grow into that valuation. That's the hope, right? That's what you're hoping for. When you overpay for a stock, what you're hoping for is that the earnings will grow into the price. That's what you're betting on. And at 22 times earnings, that bet gets a lot more difficult to come to fruition, because you need a much higher rate of of earnings growth in order to achieve that. So the problem is that if anything comes along that lowers that forward earnings projection by any significant measure, the markets will then have to reprice those valuations. Oh, I'm willing to pay 22 times earnings, but 22 times earnings based on $10 a share in earnings is very different than 22 times earnings on $5 a share. So in order to maintain that valuation level, prices have to drop in order to just to stay at 22 times earnings. If earnings drop, I've got to drop the P in the PE range, right? And that calculation measure, I've got to drop the P to match the E just to maintain 22 times earnings. So that's where the problem comes in with this entire narrative. Now, look, I just want to be really clear. I'm not poo-pooing this idea of the reflation narrative. I'm just starting to suggest that maybe we need to think about the issues of what happens with the environment, because we're banking a lot of ideas right now in the markets. A lot of our thesis, whether you know it or not, is banked upon this idea of economic reflation. Gold, silver, commodities in general, all banked on this idea of economic reflation. Stronger economic growth, more inputs, more activity leads to a higher demand for commodities, materials, etc. That all gets fed into the story of economic recovery. And if I need economic recovery, I'm going to need basic materials, industrial stocks. I'm going to need finance stocks. I'm going to need technology stocks in order to all make this work. So everybody's set to benefit from this idea of economic reflation. But this is coming. So this is Warren Buffett's favorite calculation. This is Wilshire 5,000 to the GDP ratio. So this is the broadest measure of kind of market valuations. So you're looking at the Wilshire 5,000 stocks, large cap, mid cap, small cap, it's all of them, versus the economy. And that's at the highest level on record. So again, nothing wrong with that, as long as economic growth supports that valuation. We're paying way more than what the economy is generating in actual activity in the economy, and we're paying way more for that than what it's actually generating. So again, if anything doesn't come, if this narrative of economic reflation doesn't come to fruition, markets have to reprice. And that's what's happened previously. That's what happened in the dot-com crisis. That's what happened in the financial crisis. It happened in 2022. And something came along that this idea of economic reflation didn't mature as expected, and so markets had to reprice. And that's simply just kind of the risk that we're kind of paying attention to right now. And there's just a very, very strong consensus that everything's is honky-dory, right? I mean, so here's a chart of how much will the Fed cut in 2026. And right now, the vast majority of people expect 2 more rate cuts this year. But again, why would the Fed cut rates if economic growth is doing fine, right? We're actually getting an acceleration of economic growth, but no inflation increase, right? That's Goldilocks. So why would the Fed cut rates in a Goldilocks environment? You've got economic growth, rising employment, low unemployment rates, and no inflation growth. But yet we're expecting more rate cuts in this reflationary environment, which seems a little counterintuitive. I'm not saying it won't happen. I'm not saying that at all. In fact, I'm pretty sure we will get rate cuts this year. But again, it doesn't make a lot of sense economically, and it certainly kind of falls outside the Fed mandate of just maintaining full employment and price stability. If you've got price stability and you've got full employment, why are you cutting rates? What's the biggest risk for the economy and markets in 2026? Geopolitics. Right? Got a lot of stuff going on right now. You've got protests in Iran. 500, as of yesterday, I saw the headline was 524 people have been killed in these protests in Iran, maybe more by now. You've got Venezuela. You've got what's happening with the Russia-Ukraine conflict has now just exceeded one of Russia's longest wars in history. So it's 1,000 and some odd days that this has been going on between Russia and Ukraine. So you still have that geopolitical risk out there. So again, one of those narratives could certainly crop up. And geopolitical risk, again, one of these things that are important to pay attention to, but does it impact earnings? May create some short-term volatility, but in most instances, like we saw in 2022 when this initial conflict between Russia and Ukraine started, it didn't have a massive impact on earnings. Does the Russia-Ukraine conflict slow down data center development, as an example, right? Does it slow down the activity of financing in the markets, those type of things? And that answer is really more no. It does create short-term volatility, and those geopolitical risks are certainly out there, and you need to pay attention to them because they can cause short-term market jitters. Again, if something happens, again, it's not Ukraine, Russia, it's not Venezuela, it's probably not Iran. Market's already aware of this. Market's already pricing all this stuff in. But if something would crop up that is unexpected, yes, it could probably cause short-term volatility. But immediately when that occurs, the market's going to start looking at that geopolitical event going, does that impact earnings, yes or no? If the answer is yes, we got problems. If the answer is no, market's going to push through it pretty quick and start rallying. But again, it's kind of the expected risk that it's out there. This is what we need to pay attention to. These are those headlines that can, and this is when we talk about risk management, we talk about taking profits, and especially when markets are at all-time highs, that's a good time to really pay attention to your risk management. At all-time highs, that's where we want to push all of our chips to the center of the table. But in reality, we should think about risk management because when markets are all-time highs, that's where the risk of short-term corrections becomes more exacerbated. And again, if I can take some profits, then when we have these short-term corrections, I have opportunity to buy in cheaper and pick up some assets on sale. So the questions are right now is, of course, what sectors are going to perform the best in 26 on this inflation, or I should say this reflation trade. So this resurgence of economic growth, business investment with no inflation. Technology, of course, is 31% of the respondents. Energy, financials, industrials, healthcare, and consumer staples are expected to be the better performers this year. So, maybe that's the case. We'll see. If technology is the winner, that means, we're going to kind of go back to this whole idea of the Mag 7, talk about breadth, those type of things. But this is kind of the underlying narrative of the markets. And as a function of that, this leads to a lot of ideas about where to be paying attention to. And again, I think we have to all come back and eventually talk about valuations, talk about this idea of economic growth, stability, and this general consensus that this reflation trade can take hold and we can have this massive expansion in the economy but not have any inflation. So what are the risks, right? And I think that's the biggest risk. The risk is that you get an uptick in inflation. Again, we're not talking about a spike in inflation. We're not talking about inflation go back to 9%, right? We're not talking about that at all. But if you start getting inflation at 3.5%, and you've got economic growth at 3.5%, interest rates have to come up because of, that's how interest rates are set. If I'm loaning money to somebody, I've got to consider inflation rates. I've got to consider my interest rate risk, my credit risk, all those type of things. So interest rates are going to come up if you have stronger economic growth and stronger inflation. There's a very high correlation historically between economic growth and inflation and interest rates. So it's not surprising. They all kind of operate together. So if interest rates come up, the problem with that is now you start to impact the discount rate that investors are paying for future earnings. So the risk in this reflation narrative is that you get economic growth, but you also have a pickup in inflation. That potentially leads to the Fed trying to cut rates more to offset that rate of inflation, trying to bring that down, maybe, right? But in reality, if interest rates go up, if inflation goes up, the Fed's going to have to either pause cutting rates or they're going to have to hike rates. Which again, that's the exact opposite narrative of what the market's hoping for, because in this reflation narrative, remember, it's economic growth, no inflation, and lower interest rates by the Fed. But if the reflation narrative sparks some type of pickup in inflation, that narrative is going to go out the window pretty quick. This is the risk side of this story. I'm not saying that's going to happen. So all I'm trying to do with you this morning is just lay out this case of this reflation, because this is the story that is driving the markets right now. All the markets are now gravitating towards this nirvana of reflation. All I'm trying to point out with you is like, hey, here's the case. There's certainly some supports for it, right? The OBBBA, Fed policy, data center buildouts, lots of support for the reflation story. All I'm also trying to point out to you is that there's some risk here that it's based upon a very fragile foundation of no inflation. Because you're expecting monetary easing and no inflation, and that's okay as long as that occurs. But if you get a pickup in inflation, the reversal of monetary policy will likely end. Discount rates become a problem. Market valuations become more of an issue. And if you take a look at, this is just the 12-month and 24-month forward PEs, they are not cheap. So a reversal of policy becomes a bit more of a problem. And again, I'm not saying that's going to happen at all, but I think it's worth at least paying attention to. And, this morning, just a couple of charts that kind of stuck out and caught my eye. This was a chart of the top 1% of income earners, their net worth versus virtually everybody else. Since 2010, the top 1% of income earners and really the top 1% of asset holders have become much richer because they're reinvesting into the markets. And since 2010, because of all this monetary accommodation, zero interest rates, QE, all this type of stuff, it has been a nirvana for stocks. As we talked about before, is that historically speaking, we've got the average return in stocks since 2010 has been 50% above the long-term average, going back to 1900. From 1900 to present, stocks have grown on average at about 8%, which is GDP, basically economic activity plus dividends. Since 2010, we've grown at 13%, which is nearly 50% above the long-term average. So again, that's naturally fed into those people that are holding the most assets. And if you've got assets to invest, it's been an absolutely stunning time for the last 15 years to build wealth. I think probably hands down, the last 15 years have been the most opportune time to build wealth than any other time in history that I can remember. And it's been easy to do it. All you had to do was just invest. But at the same time, we talk about the economics of all this, and it's great. Markets are doing fantastic. But when you take a look at the economy, U.S. workers are now the smallest slice of the economic pie on record. And again, we continue to see this in the employment numbers. I've talked to, yes, we have 4.4% unemployment rate, fantastic, right? Full employment, but you have 130 million people that aren't even part of the labor force. You have roughly 48% of the working age, of those that are working, right? Not working age, but those that are actually employed, only about 48% of them are employed full time. That certainly doesn't suggest that the economy is roaring on all cylinders and we need all these workers to be at work and producing and manufacturing, because that would lead to broader economic prosperity, which would start to close that gap between the top 1% and everybody else. But because of productivity increases and technology and all these type of things, like AI is great. The internet was great. These were awesome. But they also led to a big chunk of increase in productivity that required less employment. People were able to do more stuff with less employees. And AI is probably going to be one of the factors that just increases that even more. But again, this is, kind of the things that we have to look at in this reflation narrative, right? Going back to this, in this reflation narrative, what does that look like for the average person? Does this reflation narrative one that is, a reflation and broadening out of economics, where prosperity goes to more individuals because they're working, they're producing more, they've got jobs, we're providing better outcomes, because that's what economic growth should do. If we're talking about economic growth should be lifting the entire economy, not just a very small fraction of it. But what we're talking about in terms of reflation, at least from a Wall Street perspective, is that we're talking about an economy where we have less employment and more profitability. Artificial intelligence, data centers, all this is fantastic. We're going to increase the amount of productivity and profit margins for companies because we can do that by having less employees. Employees are the biggest expense for any business. So if I can cut employment, I can reduce my costs and up my profitability. That's the idea. So this is all fine. I want to show you one last chart, and then we'll wrap up the show this morning. This chart is this chart applies to the S&P and the Dow. I'm going to show you the Dow, but it also applies exactly to the S&P. This is a 125-year chart of the Dow Jones. We are currently trading at the top of the long-term trend line. Now, what does that mean? Doesn't mean anything. However, looking ahead, I think we have to be more aware that we are pushing the narrative into an environment in the economy and in the markets that we're saying, hey, everything of the past 125 years no longer matters. Valuations don't matter. None of this matters. It's a different era. This time is different. And, markets are just going to continue to escalate higher from here forever. Historically, that hasn't happened. Now, does this mean you've got to have a massive, market crash to return to long-term means? They're saying that here, just go back to the lows of 2000, 2008, you're going to have a 90% correction. I'm not saying that at all. But if you drew a long-term trend line along the bottoms of those markets going up, you're probably talking about a 30-40% correction at some point just to reverse valuations to a more sustainable level. That's the risk of the reflation story. The reflation story is fine, except that it ignores the risk of the markets. It ignores valuations, it ignores future outcomes, it ignores a lot of other factors that potentially impact that narrative. So as investors, with you listening to the show this morning, and as just to wrap this up, is I think we have to go into this with our eyes wide open and say, look, I think this narrative is fine. I certainly want to participate with it. I don't want to be out of the markets right now because momentum is your friend. But I think we do have to go into this year in particular with eyes wide open saying, hey, there is risk. And there's probably substantially more risk in the markets than what the average kind of professional investor thinks. They're very complacent. Sentiment is very high. Those typically tend to be the ingredients you need for a bigger reversion in the markets. And so from a contrarian view, when all experts agree, something else tends to happen, as Bob Farrell used to always say. At least worth paying attention to and noting. All right, that wraps up the show for the day. Thanks so much for joining me this morning. Be sure and get by the website, realinvestmentadvice.com. Get your ticket for this weekend. We're going to be going through a lot of stuff this weekend. So again, if you haven't got your ticket yet to the summit, I'd love to have you at Hotel Sonesta. We're going to feed you breakfast, feed you lunch. It's going to be a good day. Lots of time to visit, meet other people, other investors just like you, share some ideas. It's always a great day. Anyway, that's this Saturday, starting at 7:30 in the morning. Get your tickets now online, realinvestmentadvice.com. And I will be back here tomorrow. We'll do live Q&A with you. So again, I didn't give you a chance today to ask a lot of questions, but tomorrow we'll pick up with questions from today's show and get all of your inputs as well on Wednesday's Real Investment Show. All right, we'll see you then. Be sure and like and subscribe to the channel. Have a great day.